Assalamualaikum and greetings to Madam Maizura. My name is Nurzakirah SABRINA binti Norman and my matrix number is 2022871046. Today I will be presenting about chapter 1, which is basic investment concepts. Without further ado, let's begin. What is investment? Investment means to invest money for the purpose to generate income. In another words, to define investment is the investment of funds or resources in order to purchase assets or financial instruments with the objective of earning high returns over time in the form of interest, income, or growth in the instrument's value. Moving on to the next part, in financial theory, risk and return are basic ideas that are connected by the risk-return trade-off principle. Therefore, the risk meaning the ability for the actual return to differ from the predicted. Meanwhile, for the return is the amount of future value that we will obtain from an activity involving investment. Apart from that, low-risk investments are financial assets that have a smaller potential for capital loss and usually provide consistent but modest returns. Example of low-risk investment, which is bond, which issued by the government that are regarded as extremely secure and that pay back principal and interest on a regular basis. Therefore, example of government bonds is treasury bills. That short-term securities that are traded below their face value and have maturities ranging from a few days to a year. And lastly, high-risk investment is a range of financial assets with substantial risk but potential for large profits are considered high-risk investments, such as stocks, that particularly those issued by small-cap or fluctuating enterprises whose prices will fluctuate quickly. Hence, example of stock is volatile stock. Volatile stocks, which means stocks in businesses with unpredictable profitability, can see strong price shifts, providing both immense opportunity and considerable risk.
Hi, my name is FAEEZ and today I will be talking about investment objective. Investment objective refers to the specific goals that investors aim to achieve through their investment activities. This objective guide decisions such as the type of investment, the level of risk to take, and the time horizon. Each objective is influenced by factors like financial goals, risk tolerance, and market conditions. By understanding this objective, investors can align their strategies to meet their needs effectively. Now, let's explore the three key types of investment objective in details. There are three main categories of investment objective, which is capital appreciation, income generation, and capital preservation. Capital appreciation, the primary goal here is to accumulate wealth over the long term. This means increasing the value of investment rather than generating regular income. It is suitable for individuals looking to grow their assets over time, such as saving for retirement or building generational wealth. Capital appreciation investments are riskier compared to other objectives. This is because they often rely on market performance, which can be volatile. Investors must be prepared for fluctuation in value. Example, common investments include growth stock, equity mutual fund, and real estate. These vehicles provide potential for high returns but come with high risks. Next is income generation. For the goal is to focus on creating a steady and reliable stream of income to meet financial needs. This is particularly important for retirees or anyone needing regular cash flow. To manage risk diversification across multiple income streams is essential. This ensures that if one source underperforms, the impact is minimized. Examples of income-generating investment include dividend-paying stock, bond, real estate investment trust, and annuities. These instruments provide consistent payouts, helping to maintain financial stability. And for the last one is capital preservation. Capital preservation is ideal for risk-averse investors whose primary aim is to protect their principal amount. Rather than seeking large profit, these investors prioritize reducing the risk of losing money. To achieve this, strategies often include hedging, investing in stable asset classes, and focusing on diversification to shield against market volatility. Examples, investment like government bonds, fixed deposit, and money market fund are common choice for those prioritizing capital preservation.
Assalamualaikum and hi, my name is AFAF HUSNIYAH binti HASRIN and my matric number is 2022875554. Today I will be presenting the risk factors in the investment. Market risk refers to the potential for investment losses due to fluctuations in overall market conditions. Essentially, it is the uncertainty associated with stock prices that are beyond an individual investor's control. To mitigate the risk, investors can adopt several strategies. For example, analyzing the historical price behavior of a stock or security can provide insights into its volatility and potential future trends. Furthermore, we can timing the market by identifying favorable entry points can help reduce exposure to downside risk. And lastly, Maintaining emotional discipline and avoiding impulsive decisions is crucial, as fear and greed can lead to poor investment choices. Inflation risk refers to the uncertainty surrounding the future purchasing power of an investment's returns. As inflation erodes the value of money over time, it can significantly impact the real returns on investments. So, to mitigate inflation risk, investors can implement several strategies. Firstly, constructing a well-diversified portfolio that includes a mix of assets with different inflation sensitivities can help spread risk. Secondly, we can focusing on short-term securities that can reduce exposure to long-term inflation risk. And lastly, we can investing in real assets like real estate or commodities that can provide a hedge against inflation, as their values tend to rise with inflation. So for the third risk factor is credit risk. So credit risk refers to the potential loss that could arise from a borrower's inability to meet their contractual obligations or repay a loan. This risk is inherent in lending activities and can significantly impact financial institutions and investors. So, to mitigate credit risk, several strategies can be employed. Firstly, maintaining direct communication with borrowers can help identify potential issues early and take proactive measures. Furthermore, going beyond the salesperson and conducting through due diligence on the borrower's financial health and creditworthiness is essential. Thirdly, we can ensuring business transactions can provide a safety net against potential losses. Last one is we can exercising caution and avoiding granting credit overruns without careful consideration can help minimize exposure to credit risk. Interest rate risk arises from the potential impact of changes in interest rates on the value of investments. Fluctuations in interest rates can significantly affect the market value of fixed income securities, for example, bonds. To mitigate this risk, investors can adopt strategies like investing in short-term fixed securities, which relatively quickly, and limiting exposure to interest rate changes. Additionally, holding a fixed income security until its maturity date can eliminate interest rate risk altogether, as the investors receive the full face value regardless of interest rate movements.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurzakirah binti RIDZUWAN. My matrix number is 2022644122 and I will present an investment ecosystem. First, financial markets, which is Bursa Malaysia, which is stock exchanges, a centralized location where the shares of publicly traded companies are bought and sold. Second, a place for buying and selling securities. And third, provides liquidity market for investors to get capital gain. Other than that, regulatory bodies, which is first Securities Commission, established on March 1, 1993, responsible for regulating and developing Malaysia's capital markets, promote and maintain a fair, efficient and transparent capital market. Second, Bursa Malaysia, govern rules and policy to protect members from breaching the rules and policy. Last but not least, investment intermediaries, which consists of first brokerage firms, second investment bank, third asset management companies, fourth unit trust, and last venture capital firms.
Hi, my name is FARISAH IWANI and I would like to talk about the types of investment, which is the first investment is investment in securities. There's have, for example, under the investment in securities, this one is treasury bills or T-bills, which is the maturity period is less than 1 year and safe for investment because of the less risky. Next is a common share, which is have a better hedge against inflation. And bond are fixed income securities in which the issuer or borrower has agreed to make income payment that are fixed by contract. And the last one is preferred shares, which is the less risky than common stock. They pay fixed dividend and has a priority of claims on the asset of the company at the time of liquidation. Next is the investment in saving, which is the second type of investment. First example of investment in saving is saving account, which is a form of deposit account where the principal amount and the terminal value is known with certainty, such as saving and fixed deposit in commercial bank. Furthermore is fixed deposit, Similar to saving account, except that it requires a defined sum of money to be placed with a bank for a fixed period to earn interest at fixed rate. Fixed deposit, which is their time period, is equal to maturity date. Lastly is life insurance, which is the investment related to life with tax-free given. The third types of investment is investment in real estate that is related to the structure and wood on the land physical characteristic. Entities such as residential homes, raw land, and a variety of forms of income property, including warehouse, office, apartment in building, and condominiums. Fourthly, investment in collectible, which is related to antique, old stamp, and old coins. One of the advantage rate of return can be high, and the price will increase because of the unique product. Moreover is investment in gold, which is the valuable yellow metal that is used to create jewelry, coins, and ornaments. There has two types of investment in gold. The first one is direct investment, which is buy it outright as coin, and another one is indirect investment, which is we buy gold certificate, gold mining stocks, and mutual funds. Number 6 is investment in unit trust funds such as ASP or ASN that we can trust them. The last one is investment derivative securities, divided into two types, which is options and futures. Option is one party involved a contract that gives a benefit towards each other, and the futures is made to purchase or sell a specific commodity. That's the 7 types of investment and example.